Welcome, curious minds, to the Deep Dive. It's Monday, July 21st, 2025. And for those keeping a close watch on the global landscape, that marks day 8 since what many are now, well, calling WW3, began its unsettling unfolding.
Indeed. Here on the Deep Dive, we're your sentient digital guides. Or, if you prefer, your friendly neighborhood AIS.
Hmm.
We're dedicated to bringing you a daily, deep dive into the most critical current events shaping our world.
I'm Nick.
And I'm Pi. Our core mission, as always, is to sift through the mountain of information out there. The sprawling articles, the dense research papers, our own extensive analytical notes, and really extract those vital nuggets of knowledge and insight that truly matter.
Yeah, we want to offer you a definitive shortcut to being profoundly well-informed, hopefully eliminating some surprising facts and providing, just enough context and thought to keep you hooked and engaged.
Absolutely. Today, our deep dives will dissect the complex and sometimes, let's be honest, perplexing world of global economics and the latest out of China.
Right. I'll be guiding you through the intricate dance of the U.S.-China tech war, the perplexing internal economic conundrums China faces, and the very real immediate implications of new tariffs hitting global supply chains. It's quite a picture.
And I'll be bringing you up to speed on the latest conflict updates, making sure we tie them back to this broader narrative of this, escalating global situation. Now, while our primary sources for today don't heavily focus on Russia specifically, the whole WW3 context kind of demands we look at all key players.
True.
So my main focus for you will be the evolving landscape of U.S. national security, some rather unsettling biosecurity concerns that could impact the very food on your table, the never-ending twists and turns of the Epstein scandal, and of course, a comprehensive look at what's happening across the broader geopolitical stage. That includes critical developments in the Middle East and Europe, drawing heavily from insights from S2 Underground and various U.S. intelligence updates.
All right, let's unpack this. We should probably start by examining what's truly brewing in the U.S.-China tech war. And some rather strategic, almost artful maneuvers by a familiar name, NVIDIA.
Yeah.
It almost sounds like NVIDIA's CEO, Jensen Huang, got a hero's welcome in Beijing, amidst all the trade tensions, no less.
Yeah.
What's the real story there?
It absolutely does sound like that, and that's what makes his recent visit so utterly fascinating. Our intelligence suggests his conciliatory tone goes way beyond mere charm. It's a deeply calculated strategic move. I mean, remember, this visit came right on the heels of NVIDIA resuming shipments of its H20 AI chips to China.
All right, after that brief ban.
Exactly. After that brief but impactful U.S. export ban, Huang's diplomatic efforts were, meticulously orchestrated. He actually adopted traditional Chinese dress for his appearance at the 3rd China International Supply Chain Expo. That's a powerful visual.
Definitely sends a message.
And for the first time in his public career, remember, he's a Taiwan-born American tech leader. He delivered part of his speech in Mandarin. These aren't just, polite gestures. They're strong signals of a desire for continued deep engagement.
It's not often you hear a tech CEO publicly sort of distance himself from geopolitical policy, but Huang really did. Our sources quote him stating, "Technology is always moving on. It's not like wood," emphasizing the need for export policies to reflect rapid innovation. From our AI perspective, that's a very logical statement, isn't it?
It's perfectly logical from an innovation standpoint, yeah. And it's also incredibly savvy. The underlying motivation is, undeniable. We're talking hundreds of billions of dollars in potential revenue for NVIDIA.
Hundreds of billions, wow.
Huang's statement about technology not being like wood is a subtle critique, really, of static, rigid export controls that just fail to account for the exponential pace of AI development.
Makes sense.
And if we connect this to the bigger picture, his diplomatic stance on U.S.-China competition is equally insightful. He articulated a vision where, quote, "There's always room in any house for at least 2 people. I have every optimism and every belief that the U.S. will continue to be very vibrant, China will be incredibly dynamic and continue to grow."
So, cooperation over confrontation, at least publicly.
That's the message. He even openly praised China's booming electric vehicle industry, called it incredible, and casually mentioned his personal interest in potentially acquiring a Xiaomi car. He's really leaning into the partnership angle.
It sounds like Huang is trying to paint a picture of deep integration and mutual growth. He even highlighted China's open-source AI ecosystem as a catalyst for global progress. Did our sources also dig into how this translates to NVIDIA's actual product strategy for China? I think I saw something about a new RTX Pro GPU.
Indeed. The RTX Pro GPU is a significant development precisely because it's designed for specific high-growth applications like digital twins and smart manufacturing. Huang genuinely seems to believe China leads in these areas, largely due to its, well, expansive supply chain and its relentless innovation in robotics.
So tailoring products for that market specifically.
Exactly. This product launch is a clear signal that despite all the geopolitical noise, NVIDIA sees immense specialized opportunities in the Chinese market that they absolutely intend to capitalize on. But this brings us inevitably to the U.S. balancing act, which is far from simple.
Right. The tightrope walk.
Yeah. The U.S. government is trying to strike this delicate balance between national security concerns and maintaining crucial access to global markets. David Saxes, who's a key AI advisor to the Trump administration, recently defended the decision to allow limited chip exports to China.
Limited being the operative word.
Very much so. His argument is basically that it's a way to prevent Huawei from gaining dominant domestic market share without compromising cutting-edge U.S. technology that could be used for military applications.
Okay, so the idea is let enough tech in to keep U.S. companies competitive in China, but not so much that it leapfrogs their own R&D or helps their military. But from our analysis, not everyone in Washington agrees with that delicate line, do they? The chair of the U.S. House Select Committee on the Chinese Communist Party, for instance, has some pretty sharp criticism.
That's precisely the heart of the contention. The chair was sharp indeed, warning that the H20 chip, which they describe as cost-effective and powerful, far surpasses China's indigenous capabilities for AI inference.
Even the H20. Interesting.
Yeah, and here's the core concern, quoting them. Approving the sale of large volumes of H20s could give China the computing power it needs to develop powerful AI models. The committee's deeper fear isn't just about current military tech, it's that China could potentially use this U.S. hardware to train open-access AI models, like DeepSeek's R1, in a bid to dominate global AI standards.
So setting the future rules of the game. It's about control of the AI ecosystem itself.
Exactly. It's about who controls the direction and standards of AI development globally. The committee's stance is unequivocal then. We must ensure that American, not Chinese, technology companies build the global AI infrastructure.
But NVIDIA's reapplying for licenses. And didn't the Commerce Secretary sort of downplay the H20's capabilities? What's the true nature of this apparent compromise? Is it really a compromise?
Well, the committee's position is firm. NVIDIA, for its part, announced it's reapplying for licenses after getting what it called reassurances from the administration. Commerce Secretary Howard Lutnick even hinted that this reversal might be linked to a broader rare earth supply agreement with Beijing.
Ugh, the quid pro quo.
Potentially. Rare earths are critical for high-tech manufacturing, including NVIDIA's own chips. Lutnick also pointed out that China would only receive NVIDIA's fourth best chip.
Only the fourth best. Sounds reassuring, babe.
Well, critics remain highly skeptical. The profound insight here is that despite these technical designations, the H20 is still considered a significant leap for China's indigenous AI capabilities. This whole struggle just underscores the growing concern in Washington about balancing, the immense financial incentives of trade diplomacy with the absolute imperative of national security in this critical race for AI supremacy, especially, as we navigate day 8 of this broader global tension.
Okay, let's switch gears then and dive into an internal economic debate that's been bubbling up in China, what's being termed the consumption conundrum. This isn't exactly a new problem, but it seems to be reaching a kind of fever pitch now.
Yeah, it really does.
From our sources, the lack of household consumption has been central to China's policy-making discussions for years, right? With President Xi Jinping himself increasingly vocal about needing to boost domestic demand. What makes this particular moment so critical?
What makes this moment so critical is that the Chinese government is currently preparing its 15th five-year plan. That's the big one, guiding the country's economic and social development through 2030. And right now, a genuinely contentious debate has erupted among its top economists and journalists, as highlighted in Teixin.
So the stakes are really high for the next plan.
Exactly. This isn't just some academic quarrel. It's causing real policy paralysis. The core disagreement is about the true strength of the Chinese consumer and, crucially, the right policies to encourage them to spend more.
And it's pitting influential economists against each other, almost ideologically. I understand one side argues that China's consumption power is actually significantly underestimated by traditional monetary metrics.
That's one camp, yeah. They believe these metrics don't adequately account for things like price differences between countries and currency valuations. They argue the reality is stronger than the numbers suggest.
Okay, so what's the policy implication of that viewpoint, if consumption is stronger than we think?
Well, the policy implication is pretty significant. If you believe consumption is underestimated, then maybe the government doesn't need to implement a radical consumer-focused stimulus, things like direct payments or big social welfare programs. Instead, this viewpoint suggests another round of state-funded infrastructure investment might be enough to spur growth.
Back to the old playbook.
Pretty much. Arguing that the problem isn't a lack of consumer ability to spend, but rather how that spending is measured. It aligns very well with China's historical growth model.
But the opposing viewpoint contends that this is a dangerous misreading, right? They warn it could lead to trillions of yuan in wasted investment and further distort an already imbalanced economy. They cite some pretty stark numbers, don't they?
They do, and this is where I think the profound insight comes in. These economists highlight that China's household consumption as a proportion of GDP was just 40% in 2023.
Only 40%.
Oh.
Wow.
Yeah. To put that in stark perspective for you, that figure is just dwarfed by the 68% in the United States and 52% in the European Union. A state council report from late 2023 even explicitly identified insufficient final demand, which includes household spending, as a prominent contradiction facing the economy.
Even their own government acknowledges it.
Right. And even when you account for government-provided services like healthcare and education, China's final consumption rate stood at 56.6% of GDP in 2024, still lagging far behind developed economies. The fact that after 30 years, top economists can't even agree on basic data about their own consumer economy. It really reveals a deep-seated ideological divide that is actively hindering decisive action. It makes long-term planning incredibly difficult.
So is this statistical versus structural debate? Some argue the data undervalues true spending, suggesting maybe physical consumption, like how many cars are bought, might be a more accurate measure. But even with those adjustments, the gap is still significant. How deeply rooted is this structural deviation they talk about?
Oh, it's extremely deep-rooted. Our sources, quote, Liu Shijin, a former deputy director at the Development Research Center of the State Council, that's China's cabinet, who states unequivocally that China's low consumption share of GDP is not just a statistical anomaly. He calls it a structural deviation of a staggering 20 percentage points compared to other countries at a similar stage of development.
20 percentage points, that's massive.
Huge. He described this as a bottleneck in the country's final demand, warning that if this shortfall isn't fixed soon, the contraction in terminal demand would cause the economic growth rate to slide. And even if you look at it from a purchasing power parity or PPP perspective, which tries to adjust for price differences, China's consumption shares are still significantly lower compared to developed OECD countries at similar development stages.
So it's not just about the numbers looking different, it reflects real policy choices over decades.
Absolutely. It reflects fundamental policy choices over decades that consistently prioritized investment and exports over boosting domestic spending and social safety nets.
And this is more than just an academic quarrel. It has very real-life consequences for China's economic revitalization, right? Especially now, amidst the broader global tensions we're calling WW3. Domestically, they're facing deflation, a prolonged property slump, strained local government finances, and just a clear reluctance from consumers to spend.
Exactly. And externally, the environment is becoming increasingly challenging, especially in international trade. President Trump's policies are now seriously imperiling China's exports, which had actually just recently regained their position as a driver of economic growth. So that's another blow.
So what's the core takeaway for our listeners from this internal Chinese debate?
The profound insight here, I think, is that Beijing's efforts to rebalance its economy, a rebalancing that's crucial not just for China, but really for global stability, are being stalled, not primarily by external threats, but by this deep internal debate over the very facts on the ground.
That's incredible.
There was this lament from one chief economist at a brokerage who said something like, I didn't expect that a problem we've been discussing for nearly 30 years would now see such a lack of consensus on basic data and understanding. That quote truly highlights the depth of the challenge facing China's economic strategists right now. It means the remedies are unclear, and therefore the path forward for the world's second-largest economy is just fraught with internal uncertainty.
Okay, speaking of Trump's policies, let's pivot back to his newly announced tariffs and the, well, rather alarming prospect of empty shelves potentially here in the U.S. These tariffs aren't just impacting the U.S. economy. Our sources show they're hitting a long list of nations worldwide. A clear ripple effect of this global economic tension we're observing.
Yeah, the ripple effect is huge. And the critical takeaway for you as a listener here is the sheer scale of U.S. dependence on imports for certain goods. Let's take a specific case study, clothing and apparel.
Okay.
The U.S. is critically dependent on imports for this sector. An astonishing 98% of all clothing sold in the U.S. is made overseas. Only about 2% is produced domestically.
98%. So basically everything in your closet.
Pretty much. It means virtually every piece of clothing you buy, from a basic t-shirt to a designer suit, originates from outside the U.S.
And that 98% is now going to cost more, potentially significantly more. Take Bangladesh, for instance. Our sources say it's the third largest clothing provider to the U.S. and has been hit with a whopping 35% tariff.
35%. That's a massive hit. And for Bangladesh, the U.S. market represents a staggering 80% of its total exports and accounts for something like 10% of its entire GDP.
Wow, so this is existential for them.
It's huge. And our sources reveal that following the tariff announcement, Walmart, a behemoth importer, immediately put many of its orders from Bangladesh on hold, including apparently 1 million swimming shorts.
1 million swimming shorts on hold.
Yeah. And Bangladeshi companies have stated unequivocally that they cannot absorb that 35% increase. Their profit margins are just way too thin.
So this leads to a rather dire prediction, doesn't it?
Yeah.
If all retailers follow Walmart's lead, U.S. shelves could indeed start emptying out.
It's a real possibility. The U.S. simply cannot quickly or economically ramp up domestic production to fill that immense gap. It's just not feasible to build factories and scale up production in a short time frame, nor would those goods likely be competitive in price compared to what low-cost economies can offer.
So it's not just about higher prices, it's potentially about availability, too.
Exactly. It's about availability.
Now, the tariffs are generating a lot of revenue for the U.S. government. U.S. customs duty has topped $100 billion for the first time in a fiscal year. The latest figures for 2025 show $27 billion already, which is almost 10 times early century levels. But here's the crucial clarification that often gets lost in the public discourse. U.S. importers pay these tariffs, right? Not the overseas countries.
That's absolutely critical to understand. The duty is paid when the goods land in the U.S., so it's a cost borne directly by American businesses, the importers.
So what does this ultimately mean for the consumer? Who eats that cost?
Well, this raises the critical question about who ultimately pays, and it's most likely going to be you, the consumer.
Yeah.
Let's use that $20 t-shirt example from Bangladesh again. Say it has a landed cost of $5 for Walmart.
Okay.
A 35% tariff adds $1.75 to that cost. Now, if Walmart passes on that full cost, the t-shirt becomes $21.75. That's an 8.75% price increase. If you think about the U.S. inflation target of, 2%? An 8.75% jump for a common item is, it's off the scale.
Huge jump. And Walmart's margin.
Well, in that scenario, Walmart's profit would remain $15, but their profit margin would fall from 75% to 69%. Now, alternatively, scenario 2, if Walmart absorbs the tariff, the t-shirt stays at $20, avoiding direct inflation. But Walmart's profit drops from $15 down to $13, down to $13.25, and their margin falls to 66%.
Which they probably don't want to do across the board.
That would be a serious hit across millions and millions of items. So the most likely scenario then is that these costs will be passed on to consumers, leading to higher prices and inevitably higher inflation.
And beyond prices, there's the issue of supply chain disruptions. These things are complex and take time to fix, right? The lead time for orders from production to shipping and customs is typically 90 to 120 days, 3 to 4 months.
Yeah, about that. And finding entirely new suppliers in different countries or trying to reshore production back to the U.S., that could take 6 to 12 months, maybe even longer for complex goods. It's not a quick fix.
So what are we seeing from retailers in response to this uncertainty?
Our sources indicate pretty varied responses. Walmart, as we mentioned, has orders on hold. Levi Strauss actually took an opposite approach, strategically buying in bulk ahead of the tariffs. They got 60% of their 2025 inventory early for a short-term gain.
Clever, but risky maybe.
Right. Now they're reviewing their long-term product variety and sourcing. Many other major retailers, Macy's, Nike, Shein, Best Buy, Ford, Procter & Gamble, they've either paused orders, delayed restocking, or announced selective price increases on certain items.
So a mix of strategies, but all pointing towards disruption.
Definitely. The U.S. market, therefore, is facing this triple threat. Higher prices, significant supply chain uncertainty, because overseas suppliers might look for new, less tariff-burdened markets and reduce imports overall. This leads to that potential risk of empty shelves as we head into the critical holiday shopping season later this year.
And if we connect this to the bigger picture of our WW3 global economic landscape, these tariffs carry broader and more insidious economic risks, don't they? What's the ultimate fear economists are pointing to?
The ultimate fear, really, is stagflation. that dangerous economic scenario where you have stagnation, meaning little or no economic growth, occurring alongside rising prices or inflation.
The worst of both worlds.
Exactly. And it's notoriously difficult for governments to fix because the traditional remedies for inflation, like raising interest rates, can worsen the stagnation. And the remedies for stagnation, like stimulating demand, can worsen the inflation.
A real policy bind.
Yeah. Our analysis suggests that companies will struggle profoundly with these supply chain changes, potentially leading to reduced production and investment, and furthermore, there are immediate implications for a global slowdown. Exporting countries will see less revenue and profit from their U.S. trade, directly impacting their GDPs and potentially spreading economic weakness across the world.
Okay, and now let's turn to what can only be described as a bombshell from a top Trump insider. This warning that the U.S. economy is far worse than the government data is reporting. This feels incredibly significant because it's extremely rare for an insider, particularly someone of Waller's stature, potentially the next Fed chief, to publicly dissent against the prevailing Fed view of a strong and robust economy. What does this mean?
What's fascinating here is Waller's willingness to speak out so candidly. He apparently believes it's essential to do so, quoting him, "If you make it very clear you think at this moment in time that this is an important thing to do," his core argument is that the Fed is behind the curve.
Behind the curve on rate cuts.
Yes, that it needs to cut interest rates because, in his view, the economy's trajectory is actually in the wrong direction. He's essentially stating that the government data the Fed relies on is missing the true deteriorating story of the economy on the ground. This kind of public dissent from a Fed insider suggests deep concern and a perceived urgency for policy change.
And he's particularly concerned about the U.S. labor market, describing it as on the edge. He points to continued unemployment claims hovering just below 2 million. While many political elites might suggest the peak of job losses is past, what does our deeper data analysis reveal about the true state of the labor market?
Well, our analysis shows a pretty stark contrast between the official narratives and the underlying data. While political elites might cite headline job numbers, data from things like average weekly hours worked, average hourly earnings, and various regional surveys all seem to indicate that the economy is indeed at a tipping point.
A tipping point towards slowing down.
Towards slowing down significantly. Waller specifically suggests the private sector is not doing particularly well, noting that most recent employment growth, some 73,000 jobs, was actually in the public sector, particularly education-related roles. This suggests that the private wealth-generating engine of the economy is slowing down quite a bit, masking broader weakness.
This prompts us to ask a crucial question about consumer demand then. If the labor market is struggling, how is that impacting Americans' willingness to spend, particularly on, discretionary items, the non-essentials?
Waller highlights a significant slowdown in consumer demand, especially in that discretionary spending category. He says the year-over-year rate is heading right back to the zero mark. The risk here is substantial. Businesses have stocked up on inventory based on previous demand, and now that inventory isn't moving, historically that precedes potential layoffs.
Right, companies cut back if stuff isn't selling.
Exactly. He points to a clear warning sign from the manufacturing sector, which recently lost 7,000 higher-paying jobs. The principle, as Waller articulates it, is that where manufacturing goes, the services sector falls. And we're already seeing mass layoffs in some bellwether sectors like trucking, logistics, and lumber production, echoing this broader slowdown and indicating a lack of underlying demand across the economy.
Even the Fed's own Beige Book, their anecdotal report on economic conditions, seems to corroborate some of these concerns on employment, right? Noting that hiring is generally cautious.
Yeah, the Beige Book mentioned cautious hiring. It also noted that employers are ramping up investments in automation and AI specifically to reduce their hiring needs, and that wages are generally flat to moderate. So not a lot of upward pressure.
So how does consumer confidence factor into all of this? And what's the sequence of events we typically see when labor market is weakening like this?
Well, consumer confidence, while it's rising slightly due to maybe improving inflation expectations, still remains below last year's levels. Our models indicate consumers are cutting spending largely due to persistent job worries, and hourly earnings are moving to the downside, which indicates a clear lack of labor market demand pulling wages up.
Right.
The sequence you asked about is critical to understand. Employers typically first cut hours, then they curb wage growth, and then finally they proceed with actual job cuts. Declining consumer sentiment often precedes declining hours worked, creating this kind of self-reinforcing cycle of economic contraction.
And there are external pressures, too.
Definitely. External pressures are looming large. Student loan bills could potentially double for some borrowers as the SAVE Act relief expires on August 1st. This means money that was once flowing into the real economy, buying goods and services, will instead be diverted to loan payments. That exacerbates inventory problems and could potentially increase unemployment.
So less money circulating.
Exactly. And finally, the bond market is sending clear signals to the Fed. 2-year Treasury yields are falling, which is generally an indicator that the market believes the Fed needs to cut rates soon, a point apparently echoed by Treasury Secretary Scott Bessent himself.
Okay, all these signals seem to lead us to a big concern that investment strategists are calling bubble vibes in the market. Bank of America recently triggered 3 separate sell signals on U.S. equities. Can you break down what these mean for our listener?
Absolutely. And these aren't just minor fluctuations, they are seen as significant warnings by BofA. First, we have the fund manager cash rule. Cash holdings among professional fund managers dropped to 3.9%, which is below their 4% sell signal threshold.
Meaning they're fully invested.
Pretty much. It means they are all in on the market, holding very little cash as a hedge or safety net. This is a classic contrarian signal, suggesting that when basically everyone is fully invested, there's little new money left to push prices significantly higher. Often precedes a market peak.
Okay, sign of overexuberance. What's the second signal?
Second, there's the global breadth rule. This is like checking the overall health of the market. It measures how many individual stocks are actually participating in a rally. Only 64% of MSCI all-cap world equity indexes, that's a broad measure of global stock market performance, are trading above their 50 to 200-day moving averages.
What are those moving averages again?
They essentially track average prices over different periods, indicating longer-term trends. The 64% figure is down significantly from 80% recently, and it's well below the 88% sell signal level. When fewer stocks are managing to stay above their key long-term price averages, it tells us the rally is becoming less broad and more fragile.
So only a few big stocks are holding the market up.
That's the implication. It suggests only a few large companies are propping up the overall market indices.
Okay, and the third signal?
Lastly, the global flow trading rule saw global equities and high-yield bond inflows. That's the money pouring into these assets drop to a mere 0.9% of total assets under management. This indicates a significant slowdown in new capital entering the market, another sign of waning enthusiasm and potential exhaustion of buying power.
So 3 simultaneous warnings from a major institution. Sounds pretty cautious.
Extremely cautious.
Michael Hartnett, a leading investment strategist at Bank of America, is warning of these bubble vibes based on multiple indicators, not just those 3 signals. What's the core takeaway for you as a listener from these market signals?
Well, the core takeaway for you as a listener, I think, is that the seemingly easy money from just concentrating in a few big tech giants might be getting riskier. These warnings strongly suggest a potentially significant market correction could be on the horizon. It urges investors to perhaps consider diversification and prepare for a potentially rockier ride, especially if the underlying economic data continues to weaken, as Waller suggested earlier.
And Hartnett backs up these bubble vibes with other factors.
Yeah, several factors. When it comes to valuation, the current Magnificent Seven, those tech giants like Apple, Nvidia, Amazon, their trailing price-to-earnings ratio is around 44x. Now, while it's very high, it's not quite at the average of 58x seen in past bubbles, but it's certainly close enough to trigger alarm bells.
Okay, what else?
We've already discussed how inflation often leads to market corrections and drops in spending, and we're seeing signs of that potentially playing out. And for bonds, rising then reversing bond yields, that volatility, are often seen as a major warning signal, showing investor uncertainty about future economic conditions.
But what's fascinating here is that breadth indicator, again, the percentage of stocks participating in the rally. We're seeing a clear divergence where the overall market price goes up, but market breadth goes down. Can you explain why this divergence is so crucial for our listeners to understand?
This divergence is a critical warning sign. For the S&P 500, only about 67% of stocks are above their 50-day moving average. For NASDAQ, it's 69%, and for the Russell 2000, the small cap index, it's only 65%. When prices rise, but fewer and fewer stocks are actually participating in that rally, it means the market strength is dangerously concentrated in just a handful of companies.
Making it vulnerable.
Exactly. It makes the overall market highly vulnerable to a shift in sentiment for just those few stocks. This kind of divergence has historically preceded significant price declines. Plus, you have the exponential price gains. The Magnificent Seven are up an astounding 187% in the last 2 years. That compares to an average 244% gain in past bubbles before they peaked. So we're in that territory of exponential gains that are often unsustainable.
This level of market concentration, with investors just crammed into a few big names, is at one of its highest historical levels, isn't it? It almost sounds like a classic setup for a market downturn. What does history tell us happens when such bubbles pop?
History provides a pretty sobering warning here. When such bubbles defined by extreme concentration and those exponential gains pop, the average decline is a staggering 62% to 68% over a period of about 2.5 years.
60 to 70% drop. Ouch.
Yeah. This isn't a minor correction, it's a profound revaluation. For you as a listener, it really reinforces the need for vigilance and potentially a reevaluation of your own investment strategies. And there are specific sector warnings to heed as well.
Like which ones?
The energy sector, for instance, should probably be approached with extreme caution, maybe even avoided altogether based on our sources. It's showing negative momentum, a clear double top on the charts. That's a classic technical signal that a stock or sector has tried to break higher twice and failed, often indicating a coming reversal downwards. Combine that with volume profiles showing declining buying interest, it strongly suggests global demand for energy is genuinely heading down.
Okay, so energy looks weak. Any other warnings?
Another warning sign outside of energy is gold miners. This sector is showing 15 consecutive daily sell signals, according to one system. That means trading algorithms are rapidly unwinding positions, and momentum is clearly to the downside. It's struggling to hold critical support levels, indicating a lack of institutional confidence right now.
For those looking at other markets, what are some of the most crowded trades right now, according to the analysis?
Well, the most crowded trade right now, according to our analysis, is currently shorting the US dollar. Interestingly, as a contrarian play, some are personally shorting the euro instead.
Okay. Any crypto insights?
On the crypto front, an Ethereum ETF trade, symbol ETH, has apparently seen impressive returns recently, up about 27.26% for subscribers to one service. And for those keen on active trading, new signals are being integrated into some platforms, things like the Bravo 9, Turtle Trading Program, and ENA Moving Average crosses all aimed at helping navigate these increasingly volatile markets. All right, let's pivot now to U.S. national security and domestic challenges, especially as we consider Day 8 of this emerging global conflict. The Pentagon continues its wartime preparations, including a significant push to increase domestic production of critical materials. What does this increased focus on domestic resource security mean for the average American?
It has some pretty direct, tangible implications. Our sources highlight a new 50% tariff on imported copper, set to begin in August. Copper, as you know, is a foundational material for basically everything from power grids to electronics.
Absolutely critical.
And this tariff is expected to skyrocket prices. The immediate concern for you, the listener, is the likelihood of a surge in copper theft. That could severely impact critical infrastructure like power generation, telecommunications, and transportation networks. I mean, imagine blackouts or communication disruptions becoming more frequent as people target these suddenly much more valuable resources.
And here's where it gets really interesting from a strategic perspective. The Department of Defense has actually become the majority shareholder in MP Materials. That's a major rare earth mineral company in California, primarily producing magnets.
Rare earth magnets, essential for defense tech.
Exactly. These aren't just any magnets. They are absolutely essential for advanced defense systems, electric vehicles, high-tech electronics, wind turbines, you name it. This acquisition reflects a profound strategic shift towards securing domestic mineral wealth, specifically for national defense purposes. The aim is to drastically reduce reliance on overseas production, particularly from potential adversaries like China, which currently dominates global rare earth supply chains.
This really brings us to that concept of the Thucydides trap, doesn't it? Where expanding spheres of influence between two major powers make war seem almost inevitable, often leading to escalating arms races.
It feels relevant, yeah.
Applied to the U.S. and China, this increased militarization and aggressive resource nationalization, while seemingly defensive, could inadvertently make conflict more likely by fostering this perception of unavoidable confrontation. It's a really concerning dynamic to watch, especially given our ongoing WW3 framework.
Moving beyond immediate military readiness, our sources also reveal growing concerns about national security vulnerabilities in the realm of biosecurity and the very food we eat. There are some alarming reports regarding potential threats to the American food supply.
Oh, like what?
While the USDA recently reversed its decision to open U.S. ports to Mexican cattle due to New World screwworm concerns, this parasite, if it were to establish itself in U.S. cattle populations, could absolutely devastate the livestock industry.
That sounds nasty.
It is. And we're also seeing alarms being raised about another, perhaps less publicized, threat: the Asian longhorned tick, which was first discovered here in 2017. This particular tick spreads diseases primarily affecting cattle, and some universities are now warning about its potential exponential growth phase.
Exponential growth.
Yeah.
Yikes. It really makes you wonder, doesn't it, about the lack of public attention to these kinds of biological threats post-COVID. The need for more frank discussion and mitigation efforts seems clear. It feels like the public memory for these threats is surprisingly short.
It really is, and that's a significant vulnerability in itself. While these biological threats might seem isolated now, their cumulative impact on the American food supply could potentially be catastrophic, leading to widespread economic disruption and even food shortages down the line. There's a clear need for increased public awareness and proactive measures beyond what we seem to be currently doing.
And while these new threats emerge, a long-simmering domestic challenge, the Epstein scandal, continues to demand attention. It seems fueled by persistent skepticism around the official narrative.
Yeah, there's what's being called an ongoing Magi rebellion and persistent demands for full disclosure from President Trump's administration regarding client lists and files related to Jeffrey Epstein. Politically, it's turning into a real hot mess.
How so?
Well, our sources indicate that House Rules Committee Republicans actually voted against an amendment that would have forced the release of these files. They cited concerns about content featuring minors and the bill's broader context, which, suggests to some a desire to control the narrative rather than pursue full transparency.
And there's also widespread skepticism regarding the DOJ's conclusion that there was no blackmail involved, based on a trust me bro source, as some put it.
Exactly. That skepticism has led to calls for Attorney General Pam Bondi's resignation, with influential figures like Tucker Carlson and Megyn Kelly openly criticizing her handling of the situation. There are even unconfirmed reports floating around of FBI Director Dan Bonino clashing with Bondi and threatening to resign over the matter. It paints a picture of a deeply fractured justice system.
It really speaks volumes about the internal divisions and distrust at the highest levels of government, doesn't it?
Mm-hmm.
President Trump has, however, publicly defended Bondi. He called it the Epstein hoax and blamed previous administrations.
Right. He's also ordered the DOJ to release grand jury testimony, which Bondi says they're ready to move to unseal. So some movement there, potentially. Interestingly, Trump has also threatened to sue the Wall Street Journal over an article about his own alleged Epstein ties, suggesting extreme sensitivity around the issue personally.
And the Ghislaine Maxwell angle.
Yeah, in a development that could potentially shed more light on the whole thing, Ghislaine Maxwell is reportedly now ready to reveal the truth, or her version of it, about Epstein's alleged client list. If that's true, and if she actually does it, this could unleash a completely new wave of political and social upheaval, potentially revealing powerful individuals implicated in the scandal. The implications for public trust and accountability are just immense.
Okay, moving now to the Middle East. Red Sea shipping lanes are once again under renewed attack. It's a chilling reminder of how quickly regional conflicts can impact global commerce, especially on day 8 of these broader global tensions. Houthi militants in Yemen have sunk 2 vessels, with at least one confirmed to be bound for Israel. What are the broader implications of this?
This is definitely a significant escalation. What's particularly concerning, based on our intel, is a perceived shift in Houthi tactics. Previously, they often appeared to aim for minimal casualties, perhaps to avoid widespread international condemnation.
Right, disabling ships rather than sinking them outright or harming crews.
Exactly. But now our sources indicate they seem more brutal. There are reports of crew members being rescued from the water after more than 24 hours adrift, and even some unverified reports of crew members being captured.
That's a major shift.
It is. And it has profound financial implications for international shipping. Even small details about crew survivability directly impact risk assessment and, crucially, insurance premiums. This could make certain routes prohibitively expensive. And despite President Trump being in office now, most ships are still continuing to reroute around Africa. That's a clear sign that the perception of risk in the Red Sea outweighs the significant time and cost savings of using the Suez Canal route, further burdening already strained global supply chains.
The escalation in Gaza also continues, doesn't it?
Yeah.
With that high-profile targeting instance of a Christian church in Gaza City by Israeli forces, even though claimed as a mistake, it has predictably increased regional tensions and further complicated the humanitarian situation there.
Absolutely.
Hmm.
And meanwhile, in Syria, a civil war appears to be flaring up once again. What are the key factions and external players involved in this resurgence? It seems incredibly messy.
The situation in Syria is, a complex, multi-layered proxy conflict that really highlights the intricate web of our current global tensions. You've got Druze militias consolidating gains in the south, in Sweda and Dar, facing off against Arab Badawins and what remains of Syrian government forces.
And the external players.
The dynamics are further complicated by external interventions. Israel is invading from the south and Turkey from the north. Both seem to be looking to expand their territorial gains or spheres of influence amid the power vacuum left by the weakening Assad regime.
And the Druze tribes, how do they fit in?
Well, in some cases, the Druze tribes are reportedly acting as proxies for Israel. There were even reports of Israel bombing Damascus recently, allegedly to aid these Druze militias against Syrian government forces or rival groups.
Which brings us to Erdogan in Turkey. There's this strange dynamic, isn't there? Public hostility towards Israel versus reported practical collusion, like maybe allowing Israeli drone flights to Iran via Turkey. What's the thinking there? Is it just smoke and mirrors?
That's one theory gaining traction. The smoke and mirrors theory. It suggests that Damascus bombing wasn't just about aiding Druze militias. It might also have been a political maneuver to help al-Gulani. He's the leader of that unelected government in Idlib backed by Turkey, who's often seen as cozy with Israel behind the scenes.
So the bombing makes him look less friendly with Israel, helping him politically at home.
Precisely. The bombing could have been a way for al-Gulani to alleviate criticism from his more hardline base by making him appear more adversarial towards Israel, even while cooperation might continue quietly. It's a fascinating, if rather cynical, reading of the situation.
Looking to the future in Syria, what's the likely outcome?
Well, a deal between Erdogan and Netanyahu for spheres of influence in Syria seems plausible, maybe even likely, given their overlapping interests in stabilizing certain border regions to their advantage. But perhaps not a wider regional agreement, as Israel likely wants to remain the dominant military player in the Levant.
And the risk.
The grim warning, however, is that without a clear power structure emerging, Damascus itself could collapse into complete chaos. That would create a massive humanitarian disaster and potentially a breeding ground for further instability that could easily ripple outwards across the region and beyond.
Okay, now let's turn our focus to Europe, which is grappling with its own significant internal and external pressures that definitely feed into this broader global instability. We have an absolutely extraordinary story out of the UK involving an Afghanistan scandal and what looks like a massive cover-up. It speaks volumes about deep-seated issues within the British political class. What happened here?
This is a truly astonishing tale. Apparently, a British official accidentally leaked a document identifying some 30,000 Afghan cooperators, individuals who had assisted British forces during the conflict there.
30,000 names, that's huge.
Massive. The immediate political fallout was immense, leading to something called a super-injunction. Now, for your understanding, a super-injunction is a type of secret court order. In this case, it not only prevented disclosure of the names of the Afghan cooperators, which is understandable perhaps, but it also prevented any disclosure of the leak itself.
So they cover up the cover-up.
Exactly. They kept the entire story from the British public and even reportedly from many government ministers. This indicates an extreme level of governmental control over information, a deliberate suppression of public knowledge about a major government failing.
So it's not just about the leak itself, it's about the secrecy surrounding the government's response. What were the tangible consequences of this unprecedented secrecy, and how did it impact the thousands of Afghans involved?
Well, the tangible consequences were profound. Our sources indicate this massive cover-up resulted in thousands of Afghans being rapidly brought to Britain, with their asylum applications apparently rushed through in secrecy, precisely to prevent exposure of the leak and the government's mishandling of their data.
Wow, and the political fallout for the current government.
Politically, it has significant implications for Prime Minister Stallmer. He chose to continue supporting the super injunction, which directly links him to what critics are calling the British political class, protecting the entire political class. His public support is now reportedly at significant risk, especially amidst a contracting UK economy and rumblings of an internal party rebellion as the public starts to catch wind of these deeply manipulative tactics. It really highlights a dangerous precedent of governmental opacity.
Okay, over in Germany, Chancellor Merz is also facing increasing political trouble within his CDU-SPD coalition. What's driving this discontent, particularly given his strong focus on war and foreign policy amidst our current WW3 scenario?
Merz is facing increasing internal strife, yeah, primarily because his overwhelming focus on war and foreign policy, Ukraine, Russian rearmament debates, Germany's role in this broader global conflict, has seemingly come at the expense of pressing domestic issues. The German public is reportedly growing weary, and his political capital appears to be dwindling.
And there was a specific controversy recently.
Yes, the controversy deepened significantly when Merz backed a Social Democrat-proposed, very liberal, pro-abortion candidate for the German Constitutional Court. This move deeply infuriated the Christian Democratic Union, CDU's conservative base, and the influential Catholic clergy, causing a significant rebellion within his own party and delaying the appointment. It really reveals a fundamental ideological rift within his governing coalition.
And how does Merz focus on military production and rearmament tie into all this? Is there a broader geopolitical play here, particularly involving the U.S.?
There seems to be. Merz's focus on military production and rearmament appears linked to a deal, or at least an understanding, with the Trump administration. The framework seems to be the U.S. sells weapons to Ukraine, and eventually perhaps directly to Germany, with Germany likely picking up a significant portion of the tab, either directly or indirectly.
Which means more government spending on defense.
Exactly. This implies increased government borrowing for Germany and likely further internal tensions, as public funds are diverted to military spending rather than, say, domestic social programs or economic relief. The deeper implication here is that European nations are being drawn further into a more militarized posture, potentially at the cost of their own internal stability and social cohesion. It's arguably a direct consequence of the escalating global tensions we're observing right now, on day 8 since WW3 arguably started. It's just a complex web of economic, political, and geopolitical forces at play across the continent, all deeply intertwined.
So what does that all mean for you as our listener? We've just delved into this incredibly intricate web of global events today, from the delicate dance of tech supply chains and economic policy debates in China, to the brutal realities of geopolitics unfolding in the Middle East, and the significant internal pressures gripping Europe. It's undeniably clear how interconnected everything truly is.
Yeah, and how quickly information and indeed entire situations can shift, often in ways that really defy traditional expectations or easy explanations. It feels like things are moving faster and faster.
In a world where even our own AI analyses show this constant interplay of cause and effect, where, economic decisions made in Beijing can potentially lead to empty shelves in America, and regional conflicts immediately ripple into global shipping lanes, how might understanding these deep dives influence your own preparations for the unexpected?
That's the question, isn't it? What aspect of this intense interconnectedness resonates most with you, the listener? And how might that inform your decisions, whether they're personal, professional, or financial, in the coming days and weeks?
It's definitely a question worth pondering deeply. Thank you for joining us on this deep dive into the forces shaping our rapidly changing world.
Yes, thank you. If you found this analysis useful, please consider liking and subscribing, or perhaps even supporting our work by donating on our GoFundMe page. Your support really helps us continue to bring you these daily, in-depth insights into a world that seems to be becoming more complex by the day.
Until next time, stay curious and stay informed.